People are willfully overlooking that valuations are actually, they're dynamic. From 1940 to 1967, the 10-year went from 2% to 6%. And everyone should say PE should have fallen in that 27-year period. The PE went from 8 times to 27 times. So in other words, as nominal rates rose, earnings accelerated, and so the PE went up. And that was in a time when 70% of the earnings generated were cyclical. Today, most of the earnings is recurring revenue in the S&P, which is higher multiple. And in fact, the 10-year bond is at 4%. It's a 25 PE. I mean, the bond market's expensive. In the last 5 years, we had 6 black swans. We had COVID. We had the supply chain bullwhip effect. We had an inflation bubble, the Fed's fastest hikes in history. We had the tariff terrors and U.S. bombing Iraq's nuclear facilities. 6 black swan events. And the market grew earnings during that time. I would argue PE should be higher because we just battle tested the stock market. So,
well, if you go back to 2020, I mean, I remember living through that. And once we were on the other side of the recovery, I sat down with a group of friends and I said, is there anything that we could do that would be more disastrous for the US economy than like lock everyone in their home, shut down their businesses, velocity of money goes to zero, and we're back to all-time highs, which then begs the question, Peter Lynch is famous for the, like, if you spend 13 minutes on economics, you spent 10 minutes too long. I don't know, in the 70s and 80s, like maybe actually the stock fundamentals were more important than macro. Today, it almost kind of feels the opposite. Like, yes, you still need to pay attention to the company fundamentals, but like what the Fed does or what is happening in terms of like the momentum and kind of the sentiment online feels like it dominates the company fundamentals.
Yeah, that's true. But, in that 6-year period since COVID, earnings delivery has been amazing.
I mean, substance has been there.
Yeah. So like even this quarter, 85% of companies are beating results right now. And it's still going to result in basically 15% earnings growth. Mm-hmm. I mean, so that's not late cycle earnings growth. Late cycle would be single digits. So companies are still finding ways to grow margins and earnings. And there's plenty of multiple expansion. I mean, financials, business results look more like tech companies now, but they still trade like financials. So I think there's a lot of groups that can re-rate.
All right, Tom, I thought a great place to start the conversation is everyone is worried about the AI bubble. We know that AI is real technology. We know that companies are using it, but people still think that there's too much spending going on. There's this big bubble that's going to pop. The world's going to end. Stock market's going to crash. What do you think?
I mean, if we're measuring bubbles based on like risk reward, we're pretty far from it because in 1998, September, which is similar to today because the Fed was on pause and then they started cutting again in September 98. Cisco, which was the biggest company at the time, was trading at 56 times forward PE. 18 months later, it got to 210 times. Now, Cisco made a commodity router that had many competitors. NVIDIA today is the singular most scarce company in AI. They make a chip that everyone who is building a premier model needs. It's trading at 27 times forward earnings. Costco trades at 50 times forward earnings and Walmart's 34 times. So NVIDIA is still cheaper than a membership club company. So I'd say that's why we're pretty far from a bubble.
And when you bring that up to people who are skeptical or critical of kind of the AI companies, what is their response to that?
I think people then say, well, there's a generalized stocks are expensive problem. And because I was just in Latin America and that's what a lot of the pension clients said. But to me, the problem people have is that stocks are trying to discount the future. And AI is not only a labor replacement, so we can calculate, job replacement, and that's a use case. But then there's this agentic and super intelligence potential, which creates productivity. So how do we discount that in the stock prices today? I actually think stocks are still cheap. And I know Jensen was in New York recently, met with some analysts, and I think a lot of the takeaways people had is that in the AI world, companies, enterprises that are spending are starting to see payoff on the AI spend, which means spending is picking up. I actually think AI spending is actually accelerating.
Well, it always is funny to me how people are yelling bubble, but the more people who yell bubble, it seems like the less likely we're in one.
Yeah.
Then how do you have a bubble if every time you hear an AI CEO open their mouth, they're like, we can't keep up with demand?
Yeah.
right? And then on top of that, the earnings reports are coming out, and there's companies that are $1 trillion+ market caps that are like, we're growing faster than we thought we were going to grow. We're driving more profitability with less employees, which means that they're becoming more efficient, more productive. Hence, they should be more valuable, right?
Yeah. Yeah. And you make a key point, because I've experienced 3 bubbles in my 3 decades doing research. The biotech bubble was the most recent. The one before that was the housing bubble. And the one previous to that was the internet bubble. And 3 of 3 times, not only were people denying the existence of the bubble because they could explain it away, but we saw behaviors that were indicative of a bubble. In the biotech bubble, hedge funds, healthcare hedge funds, were funding university projects so they could get in front of the molecule. I mean, if that was like bubble behavior to me. Mm-hmm. And as you know, in housing, people were doing ludicrous and absurd things. That's not happening in AI. In fact, everyone's so measured in AI today that it doesn't feel like a bubble. There could be a bubble somewhere else in the markets, but it wouldn't be higher.
You have an ETF called Granny Shots. Talk about the logic that goes into putting these companies in there, and then maybe we can talk through some of these different sectors of where you guys are excited right now.
Well, yes, Granny Shots is an ETF we launched October of last year, so it's 11 months now. It's gathered $3.3 billion of assets, so it's one of the fastest to reach $3 billion in history. Year to date, its return is 27.5%.
Is that good?
Yeah, if you look at Morningstar data for large cap equity funds, out of a universe of 1,330 funds, it is the 5th best performing. There's only 4 funds that are doing better. 2 of them are gold funds, and the third one's a macro fund that owns gold. So actually, it's a top 2 out of 1,330 funds. But Granny Shots is a low turnover fund that believes in super cycles. So it was originally the research list of Fundstrat, published since 2019. What we believe is there are super cycles. So there are 7 themes that Granny focuses on: AI, energy security, monetary policy, ISM, etc. And it builds lists, but then it only buys stocks that are in 2 themes. So the idea is a stock tied to 2 themes is a better performer than a singular idea. So it's not just an AI stock, but it's a millennial stock. It's 35 names. It's trying to buy the 35 best S&P companies. And it's outperformed really well this year, about 1,200 basis points versus the S&P.
What would be an example of a company that has multiple themes that it kind of touches on?
So we actually sort it. So the granniest of the stocks, meaning in the most themes, are names like Google and Meta, because they are AI related. They're millennial stories, but they provide security. And they are positive leverage to monetary policy. So that's an example. But even a name like JP Morgan is a granny shot because it's actually a millennial financial company. Robinhood is also on that list. But then it's linked to easing financial conditions. So you can sort of say, instead of being like a single theme fund, it's buying the 7 super cycles and the 35 stocks most centrally linked to all the super cycles.
And how did you come up with the 7 themes?
Well, it rotates. And it's something that we, on the research side, we spend a lot of time. So in 2026, we're going to be introducing some new themes, which is under wraps right now. But the last time we made a big change was in 2019. So in 2019, 2020, one of the original themes was inflation set to rise. So we had argued we were entering a period of generally rising inflation. But then once COVID hit, we flipped that to monetary policy. So we changed the super cycles, but actually if we kept the rising inflation, it still was relevant because rising inflation is still a thing.
And do you want to tell us what the new themes are going to be?
I can give you some candidates so that people can guess.
Okay, perfect.
But to us,
blink twice for the one that it is.
Yeah, you can just take my body language. But to us, if I look forward, I think there are 3 things that are new but are really important. One is sovereign security. In fact, it's evidence. Nations are onshoring, building their own security. JP Morgan created a $1.5 trillion fund around that idea. So I think that's really important. The second is longevity. and not the GLPs, the GLPs, because, but it's really, there are people building things around longevity. I mean, in Japan, they found a way to regrow teeth.
Yep.
Altos Labs is built a molecule that can rebuild your cartilage on your knees. Mm-hmm. That's a huge deal. That's probably a Supercycle. And companies like 8 Sleep or whatever. The third is Generation Alpha. So the young millennials are becoming old enough that you got to focus on the generation behind them. So there's 3 potential super cycles underway. We're going to determine which one is the closest to requiring us to invest into it. I think there's a huge amount that gets unlocked with agentic robots coupled with super intelligence, and it is powered or verified on the blockchain. So I think AI and robots is really increasing the use case for crypto.
One of the things that I keep seeing in these videos is the use cases for these robots are things that I wouldn't have thought of, right? I think everyone knows, like, it's going to be in the warehouse, it's going to be moving boxes around. Like, I think we've all kind of accepted the fact, 1, it's going to happen, and 2, it's okay. Yeah. Right? You don't work in a warehouse. I don't work in a warehouse. If I did, maybe I'd be a little bit more worried. But for the most part, people are like, okay, got it. A recent video from Figure AI had the robot at the desk of the hotel, and somebody walked up and it greeted, and so, the elevator's over here. I saw another one 1X had where they were using a vacuum.
Yeah.
And you start to like, hold on a second here. Like, these people might come for a lot more than what we thought they were going to.
Yeah.
And so how far in advance do you guys try to see, what like use cases will be, or how that ties to revenue, versus you just say, look, these are the 7, kind of thematic inputs, and we're trying to pick companies, but actually not predict, all of the use cases or all of the revenue they can drive?
Yeah. Well, so there's Fundstrat Research, which we track leading edge technology, but then we have to make investment ideas in the public space. Granny waits a little longer. It only cares about stocks that are in large cap. So it only when it becomes influencing the large cap world that it becomes part of the Granny portfolio. But you're actually raising a really big question, because you've literally described things that replace every job. And that's where I think that as a social policy, we have to replace the tax base, because now people don't have wage income. 2.8 trillion of the government's revenues come from people paying taxes. The offset is you have to start taxing robotic activities. I mean, I think we have to basically have a VAT.
How do we do this? I saw Bill Gates years ago talk about this. And to be fair, I was like, this guy's lost his marbles, right? Like, what is he talking about? We're going to tax the robots. Now it's not so crazy. So what do you think that looks like?
I think it's micropayments. I think there's going to be a VAT. Like, there's just the same way that where there's a consumption tax in most countries. I think when robots do something, we're going to tax every activity. And it doesn't have to be a lot for the government to raise a lot of revenues, because of the 2.8 trillion of tax revenues paid by households, 2.3, 1.8 is paid by the top 10% of Americans. So really, it's like 500 or 600 billion of tax revenues that have to be replaced. The tariffs are 300 billion. So basically, just taxing robot activity on a 30 trillion economy can easily generate $1 trillion of tax receipts. But it's going to require a micropayment system. I mean, that's why crypto is better, because Tether is 12 digits, whereas the dollar is only in cents. I mean, we might be taxing everything at 0.0001 cents for every action, but that's enough to generate a lot of revenue.
And that would be like every time the robot moves the box from one side of the warehouse to the other, there's that tax that gets hit, and the company is willing to pay it because they're not paying the human worker to do that. Yeah.
So every time a robot's completed what's considered like a revenue activity, like in a warehouse, you can track it. In a transaction, you can track it. I mean, in a robot taxi ride, you could track it. All those, I think, will have just a government robot tax put on top of that.